First of all, top of the news, of course, the comment from Trump calling the Fed crazy. He says that the Fed's gone local, it's gone wild. Your thoughts on that?
Well, I think the Fed is far from crazy. I think it's just doing its job, which is to make sure that they fulfill their double mandate of full employment and price stability in the United States. And I think they're doing that in a very reasonable manner. And the interest rate policy that they're following and the movements they're doing also with the balance sheet are perfectly consistent with what a reasonable central bank should do. So I do not subscribe at all that comment.
Is there any reason at all to think that the Fed's moving too fast? We've seen the repercussions on emerging markets, for instance, comments from finance ministers from emerging markets saying, you know what, the Fed should be more mindful of the implications on EMs. Well,
I think the Fed has the responsibility to fulfill its mandate. And in this case, to make sure that as the U.S. economy remains at full employment, as it is now, that inflation doesn't get out of hand and is consistent with the 2% target that they have. And I think they're doing that very well. So I don't think they're moving interest rates up too fast. I think they're not. And as to whether they should be taking into account the impact of the policies in the rest of the world, I think that they do, to the extent that the rest of the world is sufficiently important so that if there are spillovers from the Fed policy on the rest of the world, and those are negative spillovers, this may spill back negatively into the United States. So I think that these interactions are factored in when the Fed makes monetary policy decisions. And this is not just the case nowadays. It's been the case already for quite some time during Janet Yellen's mandate, and I would say also during Ben Bernanke's mandate.
So, but having said that, can there be better policy coordination? We've seen a divergence. For instance, the U.S. is way ahead in its normalization process compared to the rest of the world, and that's causing the pain that is felt by the rest of the world.
Well, the United States is in a different cyclical position. The United States is growing quite strongly. After having recovered from a very, deep financial crisis, the United States has reached full employment. So I think that the Fed is doing what it has to do. I think that in terms of economic policy, the best thing is not to change the Fed policy. I think, for me, the best thing is to make sure that the policies coming out from the United States and other countries are consistent with preserving the open trade environment that the world has enjoyed since World War II, and that has so well served the world. So that's a realm of policy where I think a lot more coordination and reasonableness is necessary nowadays.
Your thoughts on the weakness in the yuan? We've heard from Steven Mnuchin, the U.S. Treasury Secretary, saying that perhaps there could be some kind of competitive devaluation of the currency. Do you see that?
Well, I do not. I think that the Chinese currency has weakened at some point, but I don't think this has been by the design of the Chinese authorities. There has been a general strengthening of the dollar vis-a-vis practically all of the currencies in the world, and I think that naturally the Chinese currency has depreciated a little, but I do not see myself, and that's my personal opinion, any deliberate strategy on the part of the Chinese authorities to weaken the currency, especially if you look at it from point of view of several years. I don't think that's the case.
Is there reason to be concerned about China's slowdown, and is China taking the right moves to stimulate the economy?
Well, I think that China has to navigate a difficult balance between, on the one hand, making sure that the economy grows at a reasonable rate, and at the same time making sure that the things that they want to do in terms of dealing with some of the financial imbalances in China are done. And my impression is that the Chinese authorities have adjusted their economic and policy, both the fiscal policy and the monetary policy, to provide economy with some support now that the economy is facing the headwinds coming from the trade conflict with the United States. And thanks to this sort of domestic policy support, China is being able to counter most, if not all, of the negative impact of the trade conflict with the United States. So I think that China's growth is going to be, still 6.5, 6.6% this year, a little bit lower next year, but very healthy in terms of what you may expect from such a large economy. So.
China at the center of the emerging market sell-off, including the likes of Indonesia as well. How has it been for banks like Standard Chartered in these markets over the last several months?
Well, we have continued to do very good business and to grow our income in Asia and emerging markets in general. And one thing which I want to mention is that if one looks at fundamentals, markets sooner or later differentiate across countries depending on fundamentals. It may be that at first market sentiment makes market move in an undifferentiated manner vis-a-vis emerging markets, but over time, countries which have stronger fundamentals are able to do better vis-a-vis markets and to earn more the trust of markets than countries that have poor fundamentals. And from that point of view, if you look, for example, at external vulnerabilities and so on, Asia and emerging markets are in a relatively better position than other emerging market areas. Now, that should not lead into complacency, because debt is high in emerging markets in Asia, both corporate debt in some countries like China, like India, but also emerging markets in Asia have high household debt, like in countries like Singapore, in Thailand, in Malaysia. So those are things that need to be monitored. But overall, I think that the fundamentals are healthy.
Jose, just one final question. The likes of Goldman saying that 2020 is the inflection point. That could be a recession. Quickly, do you see that happening?
Well, I think it's very hard to predict where the world would be in 2 years' time. But I think we should take advantage of the present situation. And the present situation is still good, in the sense that global growth, although a little bit lower in terms of the recent forecast that the IMF has issued, but also many other forecasters, global growth is going to be lower next year and this year than it was envisaged to be beforehand. But still, the growth rate is pretty good. And I think what we need to make sure is that we avoid that recession. And for that, I think the first thing is to avoid damaging global trade.